the GPs are really good at getting information. Because if you think about it, a seed company is really just an option, right? There's some studies that show like even pricing itself is really not tied to any other sort of capital markets pricing or late stage pricing. It's tied to something completely different. So with seed, it's really just an option. And so in order to really understand, how do you realize that option? These GPs are always getting information from later stage investors. There's always a set of conversation and insights and, sort of understanding of how do I position my companies to be able to, get later stage capital. And it's almost like you have like an informational arbitrage because you're getting all this information and then you're guiding the entrepreneurs and you're like leveraging that into a markup.
Hey everyone, this is Prashant and I'll be host of the VC10X podcast, and today we have Albert Azout with us. Albert is a co-founder and managing partner at Level Ventures, a fund of funds investing in venture capital fund managers and entrepreneurs building at the intersection of science and technology. In this episode, we talk about the investment thesis at Level Ventures, what they look for in fund managers, common mistakes GPs make while fundraising, how fund of funds can generate top quartile VC returns, how co-investments are a great way to generate cash flow in a fund of funds, what are the most important traits in successful GPs, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Albert, so good to have you on the VC10X podcast. How are you doing?
Good. Thank you for having me.
Yeah, it's a pleasure having you on. To start things off, can we first have briefly your story and how you started investing?
Sounds good. Yeah, so I'm a software engineer by trade. I went to school in Boston, and then I went to work on Wall Street for about 2.5 years, where I was an infrastructure engineer. And then I was living in New York, and I decided I wanted to build companies. So I did a few startups in New York. I did a large ad tech company called Stylecaster, which we ended up selling to private equity. And then I launched a machine learning infrastructure company called Velos, which was essentially helping enterprises scale out machine learning. Before that was a thing. But essentially, we enabled enterprises to get from raw data to at scale machine learning and model inference and those kinds of things. And we ended up selling the company to Verizon in 2015. With that, I ended up moving out west to Silicon Valley, to Palo Alto specifically. I worked for Verizon for about 1.5 years in their research group in Palo Alto, and then I ended up joining a firm called Coda Capital in San Francisco as a partner. There, that's where I learned the business of investing. I was, sort of in charge of, early stage investing with my partners, and I was focused on enterprise tech investing, multi-stage, usually seed, A and B rounds. And we did everything from like semiconductor to application level. We've done a little bit of life sciences, a lot of AI. And so, that's where I learned the business and the investing business. And then we started Level in 2021. shortly when I moved back east during the pandemic.
Totally, that's very interesting. And when you were starting Level VC, since you had some sort of experience with investing and also in operating, how did you decide to structure it the way it is, and also inform us about how it is structured?
Sounds good. Yeah. So, one of the things, a couple of things, one of the things that I realized when I was investing, and also I was doing a lot of angel investing, we had a family office doing a lot of investing in funds as well as companies, is, sort of maintaining and understanding the technology innovation ecosystem is quite hard, especially when you're dealing with seed companies. It's very opaque. And when I was investing, at Coda, one of the challenges was who do we network with? Who do we source from? What's happening? Where do we develop relationships in, for sourcing and for access and those kinds of things? And it's really just very difficult to unpack, that market. The other thing I realized just in the investing that I'd done in the family office was that, one of the ways in which we did really well in the family office was when we invested in emerging managers, typically they're smaller funds, and when we co-invested with them in their companies. And that was a strategy that worked really well. And so when I was starting Level, I had all these kinds of thoughts in mind. And one of the areas where we thought there could be a lot of innovation was in this sort of LP GP relationship. And there's a lot of LPs in the market. There's family offices, there's sort of institutions, endowments. There's also some fund of funds. None of them are very data driven. And typically, especially when you're dealing with early managers, there's just not a lot of track record. There's just not a lot of information to go by. And so they typically do their traditional underwriting like they would do a big firm. But that doesn't really work in this environment, in this sector. And additionally, this part of the market, small funds, tends to outperform historically, larger funds for a lot of reasons, mostly statistical, to be honest. But anyway, so we felt that there was an opportunity to redefine the LP-GP relationship. And the way we believe we've done that is we have structurally a emerging VC fund of funds where we make significant LP commitments into emerging funds. For us, that's, VC funds that are typically funds 1, 2, 3, focused exclusively on pre-seed and seed with fund sizes under 100 million. That tends to be our strategy. We also do a lot of co-investing. So what we like to do there is invest exclusively with our GPs into their portfolio companies that are entering Series B. That's the strategy for the co-investing. And then what makes us, I think, really different is for the last 3 years, we've been developing, a pretty advanced technology, which essentially aggregates data from a lot of different areas. And, what we try to really understand in the ecosystem is, what are the networks that are forming and evolving in venture, and who is sort of well positioned essentially to succeed in the next cycle. And that has to do a lot with the GPs we select. It has a lot to do with the companies that we focus on for co-investing, and it has a lot to do with with the sectors and the thematic areas that we choose to index against. And then finally is we enable the GPs with intelligence, because we found that a lot of these smaller GPs don't have the resources, capabilities, know-how to leverage technology and intelligence and AI. And the market is becoming more data-driven. And so what we do is just sort of unlock that for them as a value add. So that's a high level, long-winded way of saying that's our strategy.
Right. Yeah, that's very interesting. And is it like a 50-50 segregation in like investing into funds versus investing into direct co-investing into direct breakout companies, or how does that break into the fund?
Yeah, so in the first fund, it was meant to be about 50-50. Right now, if you think about it, the fund itself, the fund of funds deploys really slowly, and so you sort of have this effect where you're deploying as much capital to co-invests in terms of dollars deployed as the same as sort of the fund. And so we like the strategy because it creates sort of a hybrid return, sort of structure where you should get benefits from compressed J curve like DPI earlier, but also you have the benefit of having a diversified seed strategy, which I think is important. But yeah, so for the next fund, which is our fund 2, it'll be about 80% fund of funds and 20% on the co-invest side.
Got it. Interesting. And just to dig deeper on the data front, to precisely mention, how do you use data as an LP, and how does that benefit you source better and select better? And then the second part of the question is, how do you think GPs can leverage data to do investing better?
Yeah. So what we found, especially in markets, like venture, and this is more of like a philosophy, an underlying philosophy of how we think about data, is in capital markets where there's a lot of complexity and there's a lot of uncertainty, and especially in markets where there's like a lot of investment syndication, you end up having this sort of network effect where you as an investor are not making decisions sort of in a vacuum, but you are in a network or a cluster of individuals that are making decisions together, whether they're sharing deals, whether there's like flow of information. And what ends up happening is that the behavior creates the network, and then the network affects the behavior, and it's sort of cyclical. So that's why we believe we see such dispersion of performance in ventures, because it's really, there's a lot of network effects. But anyway, so that was the underlying philosophy. The question for us was, how do we take very disparate, noisy data sets and try to reconstruct the underlying networks? And so a lot of the philosophy and a lot of the underlying technology is doing that, is taking for example, the transactional data that we see in the private markets and reconstructing in a co-investor network, right? That's sort of complex. Or looking at the talent graph and trying to understand, which investors will get access to which talent pools. And so that's the idea. It's a very network-centric approach. And then what we do is, that's sort of the foundation. Then what we do on top of that is we have a bunch of research blocks. One of the core ones, of course, is scoring managers, right? So given that information, can we develop a predictive model that can tell us what is the likelihood of a manager being in the top decile of performance in the next cycle? And so that's one of the key things that we do. But we do a lot of other things as well. And in terms of like how we add value to GPs, typically it's around sourcing, and within sourcing, it has to do with just having an understanding of what the workflow is of the manager, and then augmenting it. So, for example, providing them with information on who they should potentially create relationships with, right? Or linking their internal networks with the rest of the market to see where they might have individuals that might have a certain expertise, or founders that might leave certain companies. So giving them a lot of network and relationship intelligence for them to sort of augment the things that they already do, but more intelligently.
Absolutely. That's a very interesting approach there. So I've learned that Level VC has a global focus, right? It invests across the world and in different countries, different geographies. Why did you decide to have that global question? That's one question. And the other question is, does investing in different geographies require different lenses as an LP to evaluate those markets and the complexities of those markets, and what cycle those markets are in? So your insights on that.
Yeah, for sure. So, one of the things that we think about often is where are the pockets of innovation? In venture, there tends to be clusters of innovation that could be geographically dispersed. And certain technologies might emerge in certain clusters. And so we tend to think a lot about, like, independent of the actual, geography or the sort of the emerging market itself, we just think about where will innovation come from? And so we try to be agnostic as possible. Of course, we prefer developed economies where there's sort of a fluidity in terms of starting companies, where there's sort of a healthy M&A market, where there's good trust and governance and oversight and those kinds of things. So, like, there's a lot of territories we just don't invest in, or we don't have good oversight. But we tend to invest in areas where there's pockets of innovation. And then we have data sources coming from a lot of different places, some of that which cover Europe, cover Middle East, cover other areas. And so we use that data to actually understand the same infrastructure that we do in the US, we do also there. We try to understand what are the networks, who has access, who's developing, sort of a flywheel and whatnot. So we treat it all the same. We just try to take a thematic view on where we want to invest our dollars and which sectors and thematic areas, and then who is best positioned geographically to unlock those areas. And so we have investments, in a variety of different areas, across Europe and the US.
Absolutely. So, with your data-driven approach, you have, of course, done some analysis on which managers are more likely to succeed. So, have you identified any type of backgrounds that you are particularly excited about, that the data says are more likely to succeed and are more likely to invest in success stories?
Yeah, I mean, I think it's hard to break it down into a set of sort of behaviors or psychometrics. We've actually been thinking a lot about that kind of work, and understanding, what are the sort of the psychometric characteristics GPs that might lead to success or might lead to sort of believability, credibility. We're actually working through some of these items. Generally speaking, there's a set of personas that we like. So for example, one thing we like is those that are thoughtful about understanding portfolio construction, portfolio strategy, and being intellectually honest about what they can actually execute in market, and having a good understanding of the game theoretics in the market. Like for example, you sometimes see funds that come out and they have these massive fund sizes and they believe that they can compete against sort of much more established firms, but the story doesn't really hold. And so we like people that are really thoughtful about sort of their position in the market. And then there are fund managers that purposely want to stay small because they're really driven by carry, not by fees, right? And not by management fees. And so there's like a certain mindset that requires and a certain longevity of thinking. And I think that's something that we deeply look for. The other thing we look for is more of like an internalization of what are the flywheels that I'm building here. Because there's a lot of investors that I call them deal junkies. They just like to get into deals, but there's not really a pattern of repeatability. And every single deal is sort of like its own vacuum. It's like mutually independent. And so what ends up happening is that they're not really developing a flywheel, such that the next deal will create, more likelihood that they'll get into the next best deal. And so we try to look for those that are thinking about firm building and strategic positioning with a flywheel, as opposed to just like investing in a lot of deals. The last few years, there's been a lot of tourists in the market, and it's getting into a deal. Outcomes are not always sort of a proof of really good process. And so you have to be careful about, like, is there a thoughtful, deep process there, or is it just like kind of just hunting for deals? But anyways, those are some of the things that we look for, and we try to unpack it really when we meet with the manager, when we talk to the market, and then when we look at the data.
Absolutely, that's very interesting. And what does building that flywheel look like in practice? If any GPs are listening right now, what does that firm building practice look like in comparison to just random investing and getting into random deals, right? So give us more insight into that.
Yeah, I think it depends. There's a lot of different ways to make it work. Sometimes I've seen it done with community, right? There's sort of a natural thing that takes place where, for example, if you have a specialization and you're attracting founders that are leading, I don't know, Palantir, SpaceX, or some of these big companies, and you've been sort of investing in them and proving success, like that creates a pool of recurring talent. So like specialization, of course, like if you have a specialization, it builds over time, right? There's sort of there's a learning curve where you build this information, this pattern recognition across many companies, which is very valuable to entrepreneurs. So I think specialization is like sort of one way that happens. We've seen other things like with community, like we have a fund, HF0, for example, that's has developed a program for repeat founders, best-in-class repeat founders. It's like a residency, that's like a set of programming and community building that has sort of a recursive feedback loop. So we've seen other sort of techniques, but it really depends on the fund manager and sort of what the ideas are. But that's what we look for: is what is the idea? What is that thing that makes them special and different?
Right. Totally. And talking about when you're evaluating a deal from the point you have sourced them or they have reached out to you, to the point if when you commit to them, if at all, how long does that take, and how many meetings are held in between that?
Yeah, so we don't have a defined timeline. We really try to pace with the timeline of the fund, right? So a lot of investors tell you, yeah, we have a 4-week, 5-week process, and we don't believe that. We believe that we have to pace with the pace of the manager, and if the manager is raising slowly, or if there's time, then we try to develop a longer term relationship, and that actually helps us just kind of really understand the manager, but also develop a longer term relationship. So we try to just kind of calibrate our timetables to the timetables that's required. So if there's something moving fast, we'll move faster, of course. So that's sort of how we think about it, and the process in terms of like how many interactions. It depends. It really depends. I think in cases where we need to develop more conviction, of course, we require more interactions. And where we have certain questions we want to unpack or answer, it requires a lot more interactions. I do feel like in person several times where you can really, there's a lot of nuance that happens in the physical world, face to face, that we try to really understand. And so we like a few meetings, but, I think we know when we know, right? So it's sort of like you meet someone, you say, I know. Now let me just sort of have the logical piece of the work done. And then there's sometimes where you meet someone, you're like, I'm not so sure. and then it takes a little while to develop that. So really, I think in life everything just depends.
Yeah, totally. And let's talk about some common mistakes that you see GPs make while doing the fundraising.
Yeah, I mean, I'll tell you things we don't like. I don't know if they're mistakes. They might work. It's kind of like some things work, but they're not really, they're not really great. So one thing we don't like is pressure. All right. So if you're going to develop a 10-year relationship with an LP that might commit over multiple funds where, they're a partner, to the extent that you put pressure and are not transparent, and sort of force people down to a close, or not say, or do things that you don't say you're going to do. That whole thing, that we're done right away. Like you count us out. Like we're not going to play that game. So that's something we really sort of don't like, and we try to stay away from situations like that. So that's just like an example.
Yeah, totally. Sure. So what approach do you, because of course when the GPs are raising, they are of course optimizing for a close, they do have a date.
Right.
So do you not like being given a date that okay, we are going to close by that, or you just don't want to rush it, you want your own time to do your diligence?
Yeah, it's just sometimes we feel that sometimes it's real that there's actually there's they're oversubscribed, or there's a really good amount of interest, and it's justified, right? And then we have to move fast. But a lot of times there's like this fake pressure that they sort of assume, like, oh, they're going to do a big first close, and it ends up not being there. You can kind of unpack it and get a sense for it really quickly, and it's a very small community, so everybody talks. So you can get to the truth really quickly. And so
Right.
I think that's a really big mistake, is not giving investors the opportunity to do the work, to understand the structure, the product, the strategy, and to develop the relationship, especially because it's such a
Hmm.
long term relationship. I think that's a big mistake. I think another mistake that we've seen, or that we think exists, is really around portfolio construction. There, of course, some investors believe that by growing fund size, they're able to execute just as well on a strategy. So, like for example, growing the check size into companies. Um, it takes a lot. There's a lot of conviction and a lot of work and a lot of ability, sort of right to win, that's required to be able to compete for lead positions in the best companies. And I think that a person needs to be very intellectually honest as to whether they believe that they can do that, or whether they've been able to prove that. And so a lot of times you see like these oversized funds, but not a lot of substance as to why, other than potentially they just want more management fees to build out a team. So I think like that sort of thing is something that we see as a mistake, because whatever, as you grow your fund size, you have to win, but also you have to sort of compete with the big platforms that are out there. So I just feel like that could be a very big mistake for managers in an environment where
Right.
there's a lot of LP flows. Of course, it's attractive to take more capital if it's available. But those are the hard decisions that a person needs to make, I think, in order to succeed, like in the long term.
Absolutely. And since you're looking at emerging managers, mostly people at Fund 1, Fund 2, Fund 3, are you only indexing on what's their network and what's their access, or are there other things that you're also looking at?
Yeah, we have a large, rigorous sort of qualitative and quantitative process. We have a set of scoring which gives us signal, but of course, like there's a bounds on the confidence on that signal, and so we need to do our own sort of qualitative work on top of that. But we look at a lot of other things as well. I mean, we look at the strategy. We look at whether the current the behavior of the fund and their investing activities fits the strategy moving forward. We have a lot of like data on that we look at. We look at the fit from a sector and thematic exposure, relative to where the value has been created. Sort of historically, we do a lot of work on talent. So we try to really understand the talent flywheels, the sources of talent, the archetypes of founders, the sources of the founders, the kinds of founders that they have, relative to others. So we do a lot of work there as well. And then there's just a lot of back channeling. So, we have to sort of validate a lot of these things in the market, and the best way to do that is to have conversations with the right people in the market. So entrepreneurs, LPs, other GPs, to really understand whether everything fits and holds.
Absolutely. And we're talking about fund sizes. What do you think is the right fund size for, let's say, a pre-seed seed stage fund? What's the sweet spot, or a range, if you could give, where you think is a good fund size for that stage?
Yeah, so I think this is a multi-parameter optimization problem. I don't think there's not like a one answer to this question. There's a space of answers that you need to sort of understand relative to what your ability to execute is. But I guess one structure that we like is funds that are, let's say, under 30 million, where you have where your entry ownership is let's say 2 to 3%. Would be sort of an ideal kind of scenario. You have maybe 20 to 30 companies. We think that's like a really good approach, because if one of those becomes a winner, and if you take into account dilution and whatnot, and just given the ownership that essentially implies, you should be able to see for meaningful outcomes, multiples of the fund. And I think that's like really good strategy if you can execute that well. I've seen strategies that are a little bit broader, but the broader strategy with less ownership implies a higher hit rate, and so like you have to really question whether that hit rate is sort of valid for that fund. So for a strategy like that, you'd want to see like top 2% kind of fund manager, to make sure that they can get a couple hits in there. So that's one thing. As the fund sizes grow, I think there's this sort of you want to maintain a good relative ownership in companies to fund size. So to the extent that you want to raise a $50 million fund, I think you want to see 5 to 10 ownership in companies, more towards a 10% ownership in companies, because of dilution and because of like preemptive rights and other things. And so I think ownership relative to fund size is a key thing to think about. And then the ability to write, if you're writing collaborative checks into companies, or whether you're writing sort of lead positions, there has to be, sort of the portfolio construction would change in either scenario.
Right. And do you like when early stage funds, maybe sub 30 million funds, also have a reserve strategy that they set aside a part of the fund for follow-ons, or do you prefer that they invest all of them into directly into startups just in the first shot?
I think also that depends. I always answer these questions like, oh, it depends. I think it depends a lot on the market regime we're in, right? So if you're in a regime where everything, like it used to be like everything's going up and whatnot, I think like those markets, I think reserves are less important. I think you want to have some reserves, less for defensive and more for offensive positions. Like for example, a lot of times like you're in a pre-seed company or in a seed company, and the company, it has 18 months, but like if it just had another 6 months, like you can see the milestones ahead, and you can take ownership maybe at the same price. I think there are opportunities where you can, like leverage the fact that you have asymmetric information, and still have price capture to actually take more ownership in a company that you have a lot of conviction on. And maybe depending on the A, you could also protect some of that ownership. So I think some reserves are important. I think having too many reserves implies that you're not getting enough upfront ownership, which I think is the most important, just because of the nature of the fact that the markup velocity from pre-seed to seed and then from seed to A could be quite drastic. And so you want to make sure that you have as much ownership going into the company. So I think like you want to balance that. So if it's too many reserves, I think are not good for these early funds.
Got it. Makes sense. And let's talk about portfolio construction. So how are you approaching that at level VC?
Our portfolio construction, yeah. So I think if you kind of think about it, and we'll get a little bit more statistical, but just to give you a sense for how we think. So the underlying nature of course of seed investing, early stage investing is power law distributed. That's sort of a well-known fact. It has a specific kind of like power law structure. If you're thinking about essentially investing in funds that are sampling from an underlying portfolio, underlying portfolio of power law distributed returns, you're going to end up with a curve that has like a lot of asymmetry to the right? You're going to have some funds that really overperform, and could be like, for example, a $20 million fund can be 10x. We've seen 10, 15x funds, right, that are that small. But then a lot are going to be kind of like the median is not very good, right? And so the way we think about it is if we have positive bias in sampling from the top half or the top quartile of funds, then we want to construct a portfolio where it's not too large that you have market beta, but it's not too small where there's a lot of concentration risk. And so we think that number is around 20, right? And with 20, what could happen is if you're sampling well, you could have a few, like 2, 3, or 4 funds that are like really breakouts, and then you're going to have really, really good returns. You're going to have returns even with the fees of a fund of funds that are in the top quartile of venture performance, because of the nature of the distribution. So I think a lot of investors don't understand that. I have to explain this all the time to a lot of our LPs, that this is kind of the way the market works. And it doesn't work like this in other asset classes, venture only. But anyway, so that's sort of how we think about it. So it's around 20 or so funds. We'll have a few that are kind of smaller for building relationships. And then the co-investing side is going to be somewhere in the area of 10 to 15 positions.
Got it. And also, if you could give us a brief insight into how the co-investment strategy impacts the overall returns of the fund of funds, and where does that return profile sit in comparison to venture asset class, if you could?
Yeah, so so one thing to kind of think about is when you think about the cash flows in the fund structure, the issue with these fund of funds is, or with seed fund investing, is just like there's a deep J curve, in the vehicle, just because like they're calling capital, there's management fees, and it takes a long time for the companies to actually mature and to get velocity, and so that's like a characteristic that's just it's just not a good characteristic, but it is what it is. So if we believe that if you balance that with initial sort of co-investing, right, where you're looking at later stage companies, let's say Series B ish, that essentially you have a good risk reward asymmetry because they're pretty operationally de-risked, but there's still a good amount of upside. We tend to underwrite to somewhere in the area of 5 to 10x, right? And we've seen in our own portfolio that the markups do come, and they come relatively quickly as these companies emerge and evolve. So we think that we should see better cash flows because those companies should get to liquidity faster, and then you end up like compressing this J curve, both unrealized as well as like realized. So that's how we think about it. But we underwrite each company to let's say 5 to 10x, sort of range return, net of fees, net of everything. And that's how we think about the portfolio of the co-investments.
Got it. Interesting. And from the investments you've already made in your portfolio funds, from the successful funds, what do you think has been the characteristic that has led to their success?
There's something about, I think it has a lot to do with their interaction with founders, and the trust and the insight and sort of the integrity and sort of the consistency that they have with founders, really, to be honest. That's what I think really builds durable firms. A lot of the successes that we've seen is because the founders truly believe, like they're truly the first call. Whenever there's an issue, whenever there's they're really thought partners. And I think if you do that in both good situations and bad situations, some companies just don't work, but still the integrity, the longevity, the thought partnership with the founder, over long periods of time, I think has really been one of those key things that I've seen in these funds. The other thing I've seen, and that I believe, is that the GPs are really good at getting information. Because if you think about it, a seed company is really just an option, right? There's some studies that show like even pricing itself is really not tied to any other sort of capital markets pricing or late stage pricing. It's tied to something completely different. So with seed, it's really just an option. And so in order to really understand, how do you realize that option? These GPs are always getting information from later stage investors. There's always a set of conversation and insights and, sort of understanding of how do I position my companies to be able to, get later stage capital. And it's almost like you have like an informational arbitrage because you're getting all this information and then you're guiding the entrepreneurs and you're like leveraging that into a markup. And I think that's what smart investors do. They're very, very paranoid, and they're always getting information, and they're very humble in their views. I think like that's the other thing I've noticed for the best ones. They treat it like this is an informational arbitrage, and I need to understand exactly what the market is looking for and gather insights from those that are farther along. And I think that's the other thing I've noticed.
Right. Yeah. Very useful insights there. And so this will be my last main question before we do the rapid fire round. And this is, what's been your biggest learning investing over the years?
Oh, I think this is probably like a very common learning. I think a lot of investing, of course, is not managing your portfolio, but managing your psychology. I think like that's, I truly believe that. And one really needs to be careful about narratives And a lot of narratives in the world are, especially investment narratives, especially in technology, are overly coherent. And it's because they're very enticing, and also because they're easy to unpack and understand. But when you really dig into them, there may not be a lot of substance, or the substance that's there may not necessarily happen immediately, or there might be different time scales. So investors get, I think they warp time in some ways as well. And so I think like understanding really unpacking your psychology and understanding the limitations of your ability to actually assess the situation and some of the cognitive and emotional biases that you might have, I think is very important. And so you have to get past the emotional phase of investment and into the logical phase as soon as possible. And I think like that's something I've learned, because I've fallen into that trap many times, especially when you're enticed with like this is amazing technology, or whatever. So I feel like that's a really important thing. I think the other thing is just process over outcomes, right? I think you have to really develop a philosophy, a process that's repeatable, systematic, that can be adjusted, but that has like a model of the world that you believe, and to be consistent. Because if you're not, then you're just going to be reactive to the market, and you're not going to have any sort of anchor when you see the next opportunity. And I think that's a very big danger as well, to just take, because the worst thing you can do is take signal from others, in my opinion. Anyways, I think a lot of investors, like, they need to, don't do this, but I think they really need to develop a philosophy and a way of looking at the world, and a way of understanding how they want to underwrite a company.
Useful insights there. So let's do the rapid fire round. I'll ask you 4 quick questions about the investing you're doing, and you have to give 4 quick answers, right? So the first one goes, what are the themes and regions you invest in?
Yeah, so the themes are light tech bio, which is the intersection of computation and biology; deep tech, which is hardware, software enabled solutions tackling industrials and defense; and then just generally data infrastructure, which is sort of the modern ways in which developers, both in AI as well as sort of traditional software, develop, deploy, and sort of observe applications. That's like those are areas of focus. And then geographically, we focus on the U.S. We focus on in Europe, and then in mostly Berlin and the UK, and then we have investments in Israel.
Got it. What's the typical stage of a fund where you invest in?
Typical stage of the fund itself. Usually it's fund 1 or 2, and they focus on pre-seed and seed investing.
Okay. What is the typical LP commitment size?
For the first fund, it's 5 million, and for the next fund, it's 8.
Got it. Where can GPs get in touch in case there is a direct way?
Yeah, LinkedIn, or you can go to our site, or info@levelvc.com, or my email is albert@levelvc.com.
Awesome. Last one, where can our listeners follow you?
LinkedIn is the best place to follow me.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Albert. A very insightful conversation. I'm sure will be useful for many GPs out there. Thank you so much, and I wish you all the best.
Thank you so much for having me.
Thank you.